you can understand the market selling off, financial assets taking a hit. How bad could this be in terms of the sell-off, do you think? How good could it be for the economy or not?
Well, really, again, thanks for having me. I mean, I think in one sense, a little surprised by the market sell-off because, as someone just mentioned, some of this should have been expected. I mean, given the amount of fiscal stimulus and spending that not only has been enacted, but is being talked about, I think what is fair and should be on the table is how we're going to fund those expenditures going forward. Obviously, higher tax rates are not necessarily welcome for certain investors, but I think, from what I see thus far, it's certainly not from a high enough rate to derail the recovery. And again, I think the trick will be in the details and how it's structured.
Yeah, absolutely. And this is obviously a long way from reality. Still has to go through the sausage factory down in Washington before it sees the light of day. Joe, before we even got that news, there were a lot of concerns about evaluations here, about inflation and how that could sort of chip away at opportunities out there in the market. When you look at sort of the economic recovery and all the other sort of factors in the landscape out there right now, did you still see opportunities out there to buy at some of these levels?
Certainly. I mean, I think if you look at the market overall, it is certainly modestly overvalued given the level of rates and even given what's priced in from a recovery standpoint. That said, there is what I would argue once in a generation type opportunities that investors should not lose sight of. If you look at the market in two halves, the value sort of oriented stocks and then growth tech-oriented companies, the outperformance of growth, not just this, the past 12 months, but actually for the past 10 years has been unprecedented. And some of that has been justified given the fundamentals you mentioned, lower growth, lower inflation, which tends to benefit growth companies, as well as just structural and technological change in the economy. But going forward, we see some of the fundamentals shifting and not only sentiment, but valuation supporting value stocks somewhat in a significant way over the next several years.
Joe, all of this sort of brings up the idea of these higher costs, higher input costs, higher taxes, higher labor costs, higher inflationary forces. Are these inflationary forces that are hitting the consumer, are these transitory, or do you see them as more permanent?
Well, I think this first round is transitory. I mean, we are already seeing in the commodity space, we are going to see what you have, much documented with respect to that sort of base effect as the recovery gains further steam. When we look, or when we're bolder to look out into 2022, that's an environment we'll have an even much tighter labor market. We will have, firming economic fundamentals. We're starting to see for the first time in 15 years, upside risk to trend inflation, which I think what the Federal Reserve cares about. I think it is possible that we could see 3% core inflation. We would need to see further growth, China-like growth in the year ahead. We would also need to see further fiscal spending, but it is possible. It is not the sort of impossible scenario that I think many of us may have talked about just 5 years ago.
3% core inflation. How are you preparing as the head of investment, of course, looking at the opportunities for that sort of inflation risk? How do you hedge that out? I mean, of course, you've been talking about the cyclical versus value, but where do you see that opportunity for you to have an edge?
Well, primarily two. I mean, one is it really depends on the end client's horizon. I mean, if it is a long-oriented investor that's really saving for retirement or other sort of long-term goal, it is really just making sure more than anything, staying invested in the market and letting equities, U.S., non-U.S. equities outperform inflation over long periods of time. There may be setbacks if we see an inflation scare, which we think highly likely will occur over the next 12 months. So you have to look through it. For those investors more comfortable deviating from the market, taking active risk, being comfortable being wrong, that's where my comments with respect to value stocks or to things such as modestly hedging one's portfolio in an active manager or even other parts of the market, that should be on the table. But one has to be willing to be wrong and tolerate periods of underperformance to harness that sort of upside should it materialize.
And just with regards to the general policy functions out there in Washington, both on the fiscal side and, of course, on the monetary policy side, do you see any material shifts in those policy stances anytime soon?
Well, one of my theses over the past 12 months is that we may very well be seeing, we're at the onset of a decade-long shift, pivot in the role of government. Not just in markets, but just in the economy, the size of it, what citizens around the world may demand of their governments. And so I think that has several implications. One is I think we will see a higher trend level of government spending. Again, that's not a political statement. I think that's just an economic assessment, some of which has been underspent in some parts of the economy for some time. I think the other thing is, again, on the table will be how you fund those investments in various parts of the world. And then I think, again, the role of the central banks in many parts of the world, I think their tolerance for tighter than historical unemployment rates and modestly higher inflation, I think that has been at least articulated. The proof will be in the pudding the next 2 years if they actually accommodate that.